Welcome to a brand new episode of Voices of Vayana. Today, we delve into the remarkable journey of seasoned veteran Kaushal Sampat in the information services industry. As the founder of Rubix Data Sciences Private Limited, Kaushal boasts over 25 years of invaluable experiences. During his time at Dun & Bradstreet India, he held various leadership roles, including president and managing director.
Notably, he played a crucial role in establishing Equity Ratings and Research Limited, a joint venture with SIDBI, a member of the prestigious Young Presidents Organization and Entrepreneurs Organization. Kaushal's insights and expertise promise to inspire and enlighten us. I am your host, Rashmi Shiragavan.
And I'm your host, Akshaya Shankar, and let's dive right into this captivating conversation. Welcome, Kaushal.
Thank you, Akshaya. Thank you, Rashmi.
So, moving to our first question, Kaushal, can you tell us a little bit about your background and how you got involved in this field of risk management for businesses?
Yeah, so I come from a non-information services background originally. I was in the manufacturing industry, but I was involved in our family's SME, small and medium enterprise, which was in the business of electrical switchgear manufacturing and hardware manufacturing. One of the largest challenges that an SME faces is access to credit, and that has everything to do with how banks and financial institutions, etc., perceive your risk. So I was always interested in the space, and then an opportunity came along with Dun & Bradstreet in 1998, and I joined the company and was part of the company for many years, using data in order to be able to assess risk. And it's a fascinating field. That's how I came into it, and I love that business.
Hey, that's so nice. I really didn't know that it had like such a start to it, where you were actually a part of your own family business, which probably gave you some, experience and like some insider insights for the future. I want to know now, moving on further from your experience at Dun & Bradstreet, how, when Rubix came out to be, what was it primarily set out to do? And what was the idea behind it?
So that's a great question. So, one of the things that's changing in the world is the fact that data is now available more in unstructured format. So as we all know, there are two types of data. One is structured and one is unstructured.
Yes.
Unstructured data is what is growing and growing exponentially. So social media, such as the ones that we're doing right now, so many other formats, images, etc. And AI has only grown that exponentially. Today, you can get an image from anywhere in a matter of seconds. You can auto-generate it. All that is unstructured data. How do you capture that unstructured data in order to make a risk decision? The tools of yesterday weren't going to hack it and weren't going to help you assess risk tomorrow. And that was the thesis behind which Rubix was formed. And we wanted to use primarily unstructured data, analytics, and technology. And technology here includes tools such as machine learning and artificial intelligence in order to be able to assess risk better. Our focus was always and will always be on B2B risk. So we are helping companies, banks, and credit insurers assess how credit risk, supplier risk, and compliance risk plays out for their counterparties across the world.
And also, Kaushal, just following up on something that you said, you did speak about unstructured data. So I want to understand a little bit more on that. So obviously, you mentioned as well that unstructured data like social media posts, podcasts are all valuable for risk assessment. So I wanted to ask you, what are the challenges in analyzing and extracting meaningful insights from this data? And how does one address those challenges?
So once again, Akshay, great question. The thing is that we live in what is called the data paradox or the information paradox, right? When too much information is available, but it confuses us. Too many choices, if you will. So if you hit a Google search on a particular topic, you'll get 1 million pages to view. Which of that is the truth? So our challenge really is to sift through all of that in a manner which is quick, which is economical, which is efficient, and to allow our customers to get to what we call the single version of the truth, or what is popularly known as the single version of the truth. So the challenge when I came into this industry was earlier the availability of data. I remember I had to go to the registrar of company's office, and it used to be manual files, dusty manual files. You weren't allowed to take photocopies, so you had to use paper and a pencil in order to do it. But
Wow.
those were different days. And today we're talking about the fact that you're bombarded with data. And how do you get to the data that is meaningful, that is true and accurate, and provide that to your client so that they're able to make good risk decisions? So that is the largest challenge that we face today.
I want to know something about Rubik specifically, just to digress a little bit. One of the things that it's known for, right, is custom analytic solutions that combines internal company data with proprietary data. But I think so far we've been talking more about the theory side of things or like ideas.
Yeah.
But what would be more interesting for me at this point would be to understand specific examples. So, can you maybe illustrate a few situations or like give examples of such research that has helped mitigate risk?
Sure. So let's take the example of a logistics company which wants to find out about the credit risk of its many customers, small exporters, SMEs,
Right.
large companies, who are all its customers, right? They have a
Mhm.
lot of internal data about how they're being paid by these guys, and they're basing their credit limits and their credit risk, whether to give them credit or not. So their credit risk calls, they're basing it on their internal data. What happens is really that today when a company defaults, it may default last to its most important suppliers, it defaults last to its utilities, and finally to banks. So there's an hierarchy of default, right? So when a
Yeah, yeah.
logistics company wants to assess that particular risk, if it's looking at its own data, it's not enough information to make that call. You're in an echo chamber, if you will. When you combine it with external data, number one, so you're getting a lot of external data. How is it paying not just me, but others in my industry? How is it paying its workers? Is it paying its provident fund on time? Is that company paying its GST on time? Are they meeting all their statutory commitments? So the overall health of a business is what Rubix is trying to assess. It's not enough to just have the data because you're looking at a whole bunch of data points which are coming in. How do you make sense of it and come to a score? And that's where analytics comes into play. So we have scoring models, which we've developed on over 256 sectors and subsectors. And we are able to say that, we are able to, based on this data, we assign a risk score, and we assign it, meaning the model assigns it. So we run the model and the model assigns the risk score to that particular entity. And once you have that risk score, it could be an average risk or above average risk or very high risk or low risk. And on that basis, that logistics company can say, hey, this is the credit limit that I want to give it, or I want to reduce my credit exposure to that company or increase my credit exposure to that company. The logistics company is no longer reliant on its own data. It's combining its own data with external data provided by Rubix. You can use other tools human tools in order to be able to adjust. And that's always possible. But at least you have an objective assessment of risk here through the analytics.
Got it.
Got it. No, Kaushal, I think this example really helps kind of put the ideas more in place as well. Now, I just want to get your insights on the broader theme of addressing biases in risk assessment models. So, I wanted to ask you, what steps could CFOs or the finance function of an organization take to really identify and then address these biases in risk assessment models?
Right. So again, you raise a very important point, the issue of bias in modeling. But even before you look at the issue of bias, a lot of it comes down to two factors. It depends on the data set that you're using. So if you use the closed data set, your own experience of a particular of your customers, and you're trying to take a credit call basis your own data. As I mentioned earlier, that data is an echo chamber, right? The data may throw that customer then South India pay better than customers in the West or in the East, as an example. Why? Because you may have a very strong collections person in the South or a very strong manager in the in the South who is being able to drive that, right?
Yeah.
It's not true for all customers in the South, for example, that the logistics industry that we talked about may have, but it's just that that particular company has a strong presence there and therefore is able to collect data better. That's an example of a bias. When you actually gather data from multiple sources, you are able to put it into one place. You are able to actually smooth out those biases. You take out, as we all know in statistics, you take out the outliers of the data and you try and get a good distributed data set and you apply a model onto it. When you run a model on its entirety based on industry data, you're able to get a smoother distribution. Your model throws out more accurate results for you to see. And you are able to therefore take out the natural data biases as well as the biases that the heuristics and that come into that all human beings have in terms of being able to take decisions. You're able to get rid of those and come to an objective decision.
Um, I just have a follow-up question following what Akshaya asked, right? In terms of be it CFOs or the entire organization, really, in thinking of philosophies or particular practices that can kind of outline their risk thinking. What can an organization do to better foster a risk-aware culture? And specifically, how does this culture or like the organization's risk appetite impact its strategies, particular to risk?
I think the first thing that a risk aware culture is driven by is transparency and openness. An
Okay.
organization which is open, transparent, where information flows easily between different divisions, between different levels of the organization, will always be more risk aware rather than an organization or a company where information is held in silos or people are afraid of taking up bad news to senior levels or they withhold
Mm-hmm.
information, etc.
Mm-hmm.
So I think being transparent is the first sort of building block of a risk aware culture. The second is, and this is a very human factor, don't shoot the messenger. Very often people who take bad news to their leaders or their supervisors or managers, invariably get the short end of the stick, and therefore people aren't willing to speak up. If you have a culture that actually doesn't do that, where bad news is not, penalized, as long as it's done, very, very openly without an agenda, if information is shared, I think you create a sense of comfort amongst people
Mm-hmm.
to be able to take better credit decisions because they know that, hey, some credit calls go wrong and that's all right. We learn from it and we move on. And the third is, I would say, a data driven risk culture, because any risk which is based on less than sufficient or insufficient data is going to result in poor credit calls, right? So you want to make sure that you have, or poor supplier calls. So you may choose the wrong suppliers because you don't have enough information about all the prospective suppliers. Similarly, you may take poor credit calls because you don't have adequate information. So to get a culture where everyone is sort of incentivized to collect data in a meaningful manner and legally law abiding manners. And finally, everyone needs to know the value of money. Every bad decision that you take costs the company money, especially in times when interest costs are high, the costs of capital are high. It's even worse. So, I mean, to educate people about that, about, the fact that a poor credit call or delayed payments have consequences for the P&L and balance sheet of the company, I think that becomes a very important thing to do. And it's got to be participative. So it's not the responsibility of just the credit folks or just the finance folks or just the supply chain folks. It's everyone's responsibility. Though that is a true risk aware organization.
So, actually, something you said about managing data better that really rung a bell in my head, and I kind of connected that with technology. So, in what ways can cutting edge technologies, say like AI and machine learning, enhance our capabilities and provide deeper insights into potential risks?
Number one, I think I've come to the conclusion that AI and ML are powerful tools. There's no question. Having said that, I think we're still at a reasonably early phase, especially when it comes to AI application in risk management. I think that application is just going to grow and grow exponentially over time.
Yeah.
But what I'm uncomfortable with is companies everywhere saying that we're using high-end AI or we're using AI tools in order to help you manage risk better, etc., etc. I think that needs to be taken with a pinch of salt. Yes, you may have analytics models. Yes, you may be using a little bit of machine learning, but are we really using AI to its entire, and anybody, including us, are we using AI to its full potential? I think that, it's early days yet in this entire journey. If you do credit analytics modeling, you're doing modeling, and once you have the model throwing out results and you're matching that with what's happening in the real world, and you're doing it automatically using computing power, that's machine learning, right? So the model gets better every time it comes up with risk scores, and we get experience that either affirms those scores or negates those scores. So validates or invalidates those scores. The model learns and the model gets better.
Yeah.
So that's, I would say, machine learning, and that's something that we are already using. I think that a lot is going to happen in the near future, which really excites me about the use of AI in risk management. I'm sure that it's going to help manage risk much, much better. But I don't know at this time if we are able to perceive the entire gamut of what it can do for us. One example for discussion is identity risk, right? AI is already being very powerfully used in identity risk management. When you use different tools, eKYC, VKYC, video imaging, matching videos to make sure that images that are given in KYC are the real person, doing liveness checks. So, automated liveness checks so that the person is a live person and it's not a mask, or it's not a person, a fake person or a synthetic person who's sitting out there doing the KYC. I think we're already seeing a lot of the uses, but there are so many more uses that are going to come. And I'm very excited personally about what the future holds in terms of AI, the utilization of AI in risk management.
Yeah, I think what you just said breaks down somewhat what AI and ML can be, which is just jargons. But hearing you talk about it and the example as well makes it feel a lot more tangible in terms of the applications. And that kind of brings us to our last question. And this question might seem a bit lofty, but still, I'm just going to go ahead and ask because I think it's still important for us to know. So, to wrap up, Kaushal, where do you see the future of risk management heading? What are you looking forward to in the future?
Well, risk has always existed since the beginning of time. If you don't have risk, no business can grow. Especially, I'm talking about credit risk, for example. You can work on cash and carry and grow at a particular rate. You want to grow faster, you're going to give credit, and therefore it will always, carry some risk. You know, there is a great quote from the web series Scam, which features Harshad Mehta, and it's become a sort of byword in many ways. Risk hai to ishq hai. If there is risk, there is love, right? And I'm one, for example, who believes that risk is necessary to get us out of our comfort zones and to help business grow. It's existed since time immemorial. Like I said earlier, people would use fast ships, sail ships, in order to bring information to them so that they could, I'm talking about the 19th century here, so that they could take risk decisions on pricing, on commodity pricing. They would have messengers come in quickly on horseback from different places trying to bring them pricing information. And information has always been intrinsically related to risk. She or he, anyone who has better information, faster information, will generally be able to take a better risk call than someone who's getting information with a significant lag. That is the nature of the beast. I think AI is going to only help accelerate that process. It's going to make more data available to us in ways that are unimaginable. So, I can look at a large data set, but I'm a human being, so I can look at it in a particular way. Discerning patterns is difficult. Computing does it to a different level. But when it's AI, you see patterns that never existed. And patterns with not just patterns, but patterns with causality, where a factor is creating a particular growth and risk. And I think I'm very excited about some of those patterns because earlier we didn't have the computing power, the ability to be able to detect those patterns. And AI gives us the ability to do so at scale in the blink of an eye. Even if you could do it earlier, it would take time. Today, you're able to do it in the blink of an eye thanks to the computing power of these machines, the learning ability of these machines, and they're giving you so much more rich and quick insight that you take better decisions. So that's what excites me about the future.
Thank you so much, Kaushal. With this, we come to the end of our episode. Thank you again for agreeing to join us and for such an insightful conversation. Our conversation has surely shed light on the critical importance of understanding and managing risk in the business to business landscape. Thank you again to our listeners as well for sticking with us, and Kaushal for your time and wisdom. Until next time, listeners, stay vigilant, stay informed. Goodbye and take care.